So Steve, in the last couple of months when we got together, that being August and September, the story was kind of risk off, negative capital market returns, and that filtered into negative closed-end fund returns as well as widening discounts. But when I look at October capital markets performance, looks like risk on. S&P up 8.5, high yield up about 300 basis points. Did that filter into the closed-end fund market?
Definitely. Closed-end funds were up about 5% for the month. That's all closed-end funds. On the taxable bond side, those funds were up about 4% for the month, and equity funds were pretty close to the S&P 500. They were up 800 basis points. And looking at discounts, a good part of those returns came from discount narrowing. And so all closed-end funds, I said, were up about 5, and about 200 basis points of that was discount narrowing. The taxable bond funds also had about 200 basis points of discount narrowing for the month. So that takes us to about 8% all in on the discounts, which is a lot narrower than it had been around that 10% level for the last few months.
Stripping out equity performance for a second, when I look at the sort of broad equity market via the S&P, I notice we're now back in positive territory for the year. But even despite positive performance in October from equity closed-end funds, still looks like pretty negative performance year to date. So how do you kind of think about the lagging of equity closed-end funds?
To say lagging is certainly an understatement. The equity closed-end fund group is down about 12% year to date, even with October's rally of 8%. And the reason for that is that closed-end funds are not benched against the S&P 500. There's very few funds that actually use the S&P 500 as their benchmark. And the reason for that is that closed-end fund investors want yield, and the S&P 500 is not going to deliver a juicy enough yield to tempt the closed-end fund investor. And so when you look at the space, just looking at the top 10 equity closed-end funds, about a third of them are MLP closed-end funds. You've got a large utility fund in that group, and then also a number of covered call funds, which are selling away part of the upside in return for the income. And so when you look at the space, there's a lot of diversification outside of the S&P 500, and so when the S&P 500 does well, it's certainly reasonable to expect closed-end funds to do well because there's certainly a high correlation, but the beta of the equity closed-end fund group is much below 1. I mean, you look at the funds or the names that have worked really well in the S&P 500 this year. You've got Netflix, Amazon, Facebook, Google. There's very low ownership of those, no dividend names in the closed-end fund group. And so it is frustrating from an investor standpoint to look at the closed-end fund space and see that large lag. But over time, we believe that the diversification is good. And as a manager in the closed-end fund space, we certainly have the opportunity to allocate to S&P 500 type closed-end funds, but also to gain some of that diversification as well.
My takeaway from that is, as an investor, just be careful about looking at S&P returns and translating that into equity closed-end fund returns. You're not exactly getting the same beta exposure from the majority of the equity closed-end fund universe.
That's true. There's only about 24 equity closed-end funds that are specifically targeting the S&P 500.
Steve, last question. So here we are in early November. We've talked, or we're on record in the last couple of years of talking about tax loss selling in the closed-end fund world, which I'm assuming is kind of about where we are right now on the calendar. So what are your thoughts about how tax loss selling season might be going at this point?
It's certainly an exciting topic in closed-end fund space. Discounts generally widen in the fourth quarter if there are year-to-date losses. And the reason for that is that investors harvest the loss and redeploy the capital into a similar investment strategy while harvesting that loss from a tax perspective. What I think is going to happen this year is that we've already seen the low on discounts. Our viewers have certainly appreciated the volatility in the last 2 months. Discounts actually bottomed on August 24th when the Dow dropped 1,000 points. And so when you have that kind of discount volatility, it's unlikely we'd see the typical pattern of discounts bottoming probably mid-month, early November. But again, I think that where we are today, discounts are certainly attractive enough that I wouldn't be too cute about timing an investment in closed-end funds. And on the flip side, if you have losses year to date in any of your mutual funds or ETFs or even another closed-end fund, it makes a lot of sense to harvest that tax loss and redeploy into what I think is a very cheap closed-end fund opportunity.
Steve, thanks as always for your comments.
Thank you.